welcome back to the Forager Investor Roadshow 2020. Now I say welcome back because I do know that some may have had difficulty getting into the presentation earlier in the week, but we have the team assembled to answer your questions once again. With me here is Steve Johnson, he's CIO. We've also got Alex Shevelev, who is the Senior Analyst for the Australian Shares Fund, and also Gareth Brown, who is Co-Portfolio Manager for the International Shares Fund. So we are going to be answering questions. We will be getting potentially stock specific, depending on the questions that come through. One thing that you'll need to keep in mind, though, is that these questions are not, and the answers are not specific to your situation. So the information is general in nature. You still do need to take your own personal circumstances into consideration and get financial advice before making any decision. So with that being said, welcome. We look forward to getting your questions. You can get them in coming in live. We will get to as many of them as we can in the next half hour, 45 minutes. A lot of it is up to you. Gentlemen, welcome. Good to see you again.
Hi Nadine, thanks for coming back.
Okay, so let's get right to it, shall we? We've got the Australian Share Fund. First question. Australian Share Fund has a considerable investment in RPM Global. I think this is for you, Alex. How do you justify such a large holding? Maybe just tell us what it does for potential investors who are not aware, and then you'll have to justify why you've got such a large holding.
Yeah. So look, it is a very interesting business. It is a mining software company, and a lot of mining software is written in Australia by virtue of our involvement in mining over time. It's a company that has a very large market share in certain key products, almost to the point of almost being a standard for certain areas that they participate in. It's been spending a lot of money developing that software, but it also has a very long history here of growing their maintenance revenue over time. More recently, the business has switched up into doing subscriptions, and that is growing very quickly as well. So very high quality recurring revenue streams, a net cash balance sheet, quickly growing and flying under the radar. So if you look at next year, excluding the excess cash that's sitting there on the balance sheet, you're talking about a multiple that's 10 or 11 times earnings, which for a business of this quality is a pretty rare find.
And weighting-wise, I mean, how do you think about what's the right weighting for a business like this? We obviously like its prospects. We think it's relatively safe in terms of predictability in the balance sheet. And the question there was about trying to justify the size of the weighting. We had a couple of other questions earlier in the week as well about some of the things that have gone wrong and whether that's changed our view of what the right weighting is for a large position in the portfolio.
So I think this one started off as a lower weighting, and it has that weighting has grown firstly by virtue of the share price itself going up, and secondly by virtue of the rest of the portfolio underperforming that particular one. You may have seen actually we put out a change in substantial, so we've reduced that back to a lower position sizing, but it is still around 10% of the fund. It's something we've got a higher level of confidence in than a lot of other companies, and given the recurring nature of the revenue and given the net cash balance sheet, and one other thing I should have mentioned earlier, the management team there, who are very well incentivized, given their own shareholding in the business, to succeed.
Yeah, I think one thing in general when you're invested in a fund, and particularly with us, I wouldn't take too much notice of buying and selling because we're constantly trying to get the right weight rather than thinking, oh, we hate this business, so we're going to sell it, or we love it, so we're going to buy it. We can love a business, and because of other changes in the portfolio, it's gone from a 10% weighting to a 13% weighting. We still love it, but we think 10 is the right weighting. So to get it from 13 to 10, we've got to go and sell some stock. And it's something we've actually been juggling a lot in volatile markets and trying to get the right portfolio together every day with the right weightings in all of our stocks. And sometimes that means selling something that you really like. And sometimes it might mean buying something that you had sold at lower prices previous. And we've had a bit of that with Linamar, Gareth, where through the crisis there were better opportunities. Some of those things have rallied really hard, and we've come back to something that, even though the price is up 10, other things in the portfolio are up 40 and 50, and it's time for us to recycle back into some of those.
And fundamentally, you still like it.
Exactly right.
Yeah.
Yep.
So it's about the opportunity set as well as the individual situation. So obviously, we're taking each piece of news and we're comparing it with the price, but we're also comparing it with what's available elsewhere in the portfolio and things that are outside the portfolio as well.
Mm-hmm.
And Gareth, while we're here, we've had those three stocks in the international fund that have doubled and more over a short period of time, and we've been trying to make sure we make an appropriate amount of money out of those stocks, but also make sure we manage the risk of the weighting getting too big as well. One of those, Celsius, that we talked about earlier in the week, was up 30% last night. how are you thinking about some of those things that have performed really well for us on the selling side as well?
I mean, that's really a big part of the art of investing. I think that to find the discipline to not sell out of the best ideas too early, and to also to give them the room to run and the space to run. I don't have a mechanical answer for that, but yeah, when it's the right stock, you should sell slowly is the answer.
I think particularly at the small end of the market, as things grow and they become accessible to a wider range of investors, the process of value realization can just take time. And I think we've got something there where we're, even if the price falls 20 or 30%, we're really confident in the growth of the business over the next 4 or 5 years. So, you know, we have taken quite a bit of money off the table as it's
You're talking about Celsius now.
Yeah. Well, even, I mean, GAN, another stock in the international fund, has been similar, but taking it off the table as it runs up, and if you get those pullbacks, which you often do, it's an opportunity to put some money back on the table as well.
Okay, before we get too far away from RPM, another question has come in on that. So you say in the presentation that RPM is in the upper right quadrant of your slides, but you sold down RPM in June, July, according to the notice that was published to the ASX. Can you explain?
Yeah, I mean, I think we just answered that question really in terms of us trying to get the weighting right. We've had a 10% target in the stock for some time now. There's been a lot of volatility in the portfolio. It was up to 13 or 14% because of its performance and other stocks going down. And we've just been trying to get that balance right between it and the other opportunities in the portfolio. I wouldn't take it as any diminishment of our excitement about it at all. Okay. 10% for us is still a very big weighting.
Steve, this one's for you. Could the International Fund team comment on their experience investing in Asian stocks, I mean, Gareth, you as well, and the decision to make Paul Qua's Asian stock picker position redundant?
Yeah, it's been a really difficult space in general for us in Asia. We've tried multiple things up there. We've tried to apply our style of investing to those markets without a lot of success, and we've tried to be a bit more adaptable and bring in some expertise. We just weren't getting the number of ideas in the portfolio, or the type of idea that the team and the philosophy and everything that our business is about. It needs to be consistent with that. And we just weren't finding enough of those up there where we were all confident in the future of the business to justify the cost of that resource in the company. You know, you never say never, but I think for the foreseeable future, we're going to concentrate on the markets that we know and that we have experience in. And we've seen over the past 12 months that there are more than enough opportunities in those markets for us to do well.
Okay, I think this one is an amalgamation of a few questions. So there's been a handful of questions about Thorn. What are your reasons for retaining the stock? And yeah, I guess an update on your activism with the board. How is that going?
Do you want to touch on it, Alex, or would you rather me take that one?
I mean, I'm happy to touch on the surrounding issues. Yeah. I mean, in short, this is a business that used to have a physical presence in the radio rentals consumer leasing space, and it had an equipment finance business. Now, COVID has thrown both of those businesses into a tailspin. The equipment finance business has suffered a lot of people not paying for the equipment that they have financed. That's an issue, but the debt that sits alongside that is remote from the rest of the business. In the meantime, the radio rentals stores were shut, and subsequently they were permanently closed as well. So now we've got a situation where there's quite a bit of cash on the balance sheet, remote from the equipment finance business, and we've got cash coming in from collections of consumer leasing that had occurred 2 years beforehand.
And it's actually been quite a good environment for collecting on that money, because people, you know, the welfare has doubled, people are on JobKeeper, there's more discretionary income in that typical client market of theirs than there was historically. So it seems like from the cash flow statements that we're seeing that cash flows have been a bit better than expected. It has been a bad investment for us, but the share price movement here was extraordinary. This latest cash flow statement that came out, the company's got 44 million of net cash on the balance sheet. We think that is going to go up quite substantially over the coming 18 months. And the market cap a month ago was less than $30 million. So it's gone from, you know, there's just so much investor hatred for the stock that the share price reaction was so extreme that what was a difficult investment for us, I think there has been progress made. It's now quite a bit of cash on the balance sheet. And on the board side of things, we're in constant communication with them. I think they are juggling up some options here around whether they want to restart some of these businesses or not, whether that is going to be economically feasible. we're not keen on the idea, and we've made that clear to them, and I think they're trying to juggle a bunch of different shareholders telling them different things. So I would expect that over the coming months, you're going to see some clarification from the board there, and maybe some noise from us as well around which path it's going to go down. And our preferred one is just that cash is returned to shareholders over time. There's a big balance of franking credits there as well. It's uncertain whether they can be distributed as part of the distributions, but from today's price, we're pretty confident you're going to get more back in cash over the next couple of years.
And how do you communicate, if at all? Is there a need to communicate with your investors about how you're traveling when it comes to engagement with the Thorn board? Yeah,
it's a difficult one because I think a lot of that needs to happen not in the public sphere, and we want to work with most boards to try and achieve the outcomes that we want. But we often have a lot of our investors might go and invest in a stock on the side as well because of what they've read in our reports, or they like the idea. So I think in this one in particular, there's quite a few people that are interested because they've also got a bit of money in it on the side. And we would like to communicate to them our preferred path, and we would like them to communicate with the company where they would like to go as well. So we just try and juggle that between, okay, can we get the outcome that we want here just by dealing with the board, or do we need to be a bit more public? Do we need to involve more of our investors in trying to achieve that outcome? We've probably been a bit passive, to be fair, over the past few years. I think on Thorn in particular, we should have been more aggressive much earlier on, and we'd be in a better place today if we were.
Okay, there is more on Thorn, so obviously it's resonating. These are live questions coming in. Thank you. Keep them coming. Is there a risk of further downside? How capable and profitable will the online radio rentals business be, Alex?
Ideally, in our view of a world, the online radio rentals business doesn't need to proceed in the size and scale of the old model, and perhaps it doesn't need to proceed at all. The question is, can we make decent returns there out of our business? The board will have to make that assessment. It feels like the era of charging the sort of interest rates that the business was charging historically is probably over, drawing to a close. So ideally, there is cash coming back, and we'd like to see that in shareholders' hands.
And there are options here. I think doing this in a public company has proven to be very, very difficult and expensive, and it's shrunk to a size that it doesn't make a lot of sense. That doesn't mean that radio rentals business in an online version is not interesting to someone else. There's a huge amount of cash here, and there's a brand that has resonance, and there's a customer base that is tens of thousands of past customers as well, that someone may look at and say, well, I can make a business of this. So now the board is weighing up, do we sell it? Do we just run it down ourselves? Do we restart it ourselves? All of these options are ahead of them. We've got our preferred path that we've made very clear to them, and I think it will really come down to where the weight of the shareholders sit in terms of their preferences. I don't think the board is going to put up huge obstacles to what the shareholders want. I think they want to do what is best for shareholders. It's just working out what that is.
Okay. We touched upon Star Group the last time around, and that was sort of through the prism of ethical investing. I think you answered that quite well. Another follow-up question has come in on Star, though. It says, why Star Group versus Crown? And second question, pretty much the same, but especially with Crown Sydney coming online shortly, can you comment on this as well? So just down the street from us here in Barangaroo, big shiny building has gone up. It's now got the Crown insignia on it. So yeah, how come? Star.
That's a good question. I actually think you'll do fine in the whole space. You pick any of them and you'll do okay, because I think it is ultimately long-term a very resilient cash generative business, and they're trading at some of the more attractive prices that we've seen in a long time. But Alex, you've done the work on them. Why don't you talk about the different options there? And we've also recently invested in Sky City, which is the New Zealand casino owner, and maybe explain the three different options there, and I guess why we've picked the two we have.
Yeah, I mean, I think the starting point here is they are all holders of assets that are quite long-term in nature. And they're actually perhaps a little bit different to how they've been trading in the last little while. They're actually quite domestically focused. So if you can take a VIP component, most of that is international. That's in the order of 8 to 10%. There's probably another 7-8% there of tourists walking onto the main floor. So really what we want here is a domestic restart for all of those assets to start making the sort of returns that they were making prior to COVID. The Crown business has had less debt, so it dropped less during the COVID issues, and it has risen more. Star and Sky City had higher debt levels. Sky City has raised some money to assure investors of that. Generally, their businesses we see a little bit more upside in, and we've weighted them accordingly given their liquidity, given that they are continual exposures to COVID reopening. And we've actually done both Star and Sky City to give us a little bit of a mix across the different reopening schedules that might occur here and in New Zealand.
I think, when Alex first went off and did the research and came back to me, my impression was that Crown was probably a better asset, Melbourne CBD in particular. But when we went and crunched the numbers of the past 10 and 15 years, the other two have actually had much better returns on capital, incremental capital, so the money that's been put in over time. And Crown's done a couple of things on the balance sheet that haven't been great, particularly the Perth redevelopment over there that hasn't turned up in any incremental earnings at all. So we're quite confident about the growth potential for the two that we've invested in, and they're cheaper in terms of multiples as well. So that's the reason we've gone where we did.
I'm curious to know, we've got stage 4 lockdown in Melbourne. So obviously this COVID pandemic will have reverberations that perhaps we didn't know months ago. So when it comes to Crown, Star, Sky City, is the reopening and the potential delaying of even interstate travel now becoming more of a concern?
It is. I still think, worst case, you're going to lose 6 months to a year of earnings here. You may be going to have 2 years of recovery out the other side of that. I think there's a good chance it might be quicker than people are anticipating, but you've got share prices that are down 40 and 50%, so they're basically assuming that the earnings power of these assets are permanently impaired. And what we've seen through the little opening up window that we've had, and New Zealand that is more open, is that it's bouncing back really, really quickly in terms of people going back and spending money. So this is definitely a setback for Crown, for all casinos, because they're dependent on tourism, but Crown in particular because of its Melbourne asset. But I still think you can look through that to a couple of years down the track and say this is still a very, very difficult asset to replicate. Gareth, we've seen, Europe and the US a bit of a setback recently in terms of the short-term economic activity numbers coming out of it. Has it changed your mind about how you think about risks around investment in the short term?
In the point for the gambling assets here you're talking about?
Well, I'm just talking about the general portfolio implications.
Well, there's a trend here that's sort of become fairly evident to everyone that the closer to home the spending is, the better it's doing at the moment. So I look at a company in the UK that sells sofas. For 22 March to 22 May, their sales were down 92%. So it was effectively 100%. And then the following 2 months, their sales were up 100% on the prior year. So spending close to home, things in the house, it's doing really well. Buying cars, doing really well. I would put going to the local casino, if it's open, and putting money in the poker machines is probably in that same bucket. So, yeah.
I'm curious, Motorcycle Holdings came out yesterday, Steve, and referenced the Victoria lockdown and the impact that it could have on the business. Alex, this for you as well. Do you see these, this Victorian lockdown as pronounced for any of your holdings, especially in the travel space, or can you and will you be looking through it?
I think in Motorcycle Holdings' case, it is about a $10 million revenue impact. You're talking maybe 2-3% over time. That's what they've said so far for the Melbourne component of the business. But just looking through, and the setup of the situation itself is that we had a motorcycle market here that had been depressed for a number of years. We had a business that's led by an interesting founder manager who has soaked up more than 10% of the Australian new motorcycle sales. Focus on Queensland, less of an exposure in Victoria at the moment. But through that growth, loaded up on debt, perhaps a little bit too highly. What we then had is, as Gareth was saying, a sharp drop-off, but then a very sharp rebound in the number of bikes sold. The accessories that flowed through that as well helped a lot. They've got a wholesale accessories business as well. And what they've done is reduce dramatically the debt load, and that was one of the concerns. So from here on in, we've got the potential for loan riders to be a bigger part. Now, we didn't see that in the half-year industry results yet because people really haven't come back to work, haven't had the need to travel in that fashion. But it should be something over a couple of years here that you get a bit of a boost on. And you've had some of the farm-related motorcycles, the all-terrain, etc. Those have benefited from a couple of government policies. Overarching all of this, the ability to take money out of super pre-June and subsequent to June has really helped in the motorcycles that are sub 10,000 range. So if you talk to the company, they'll say a lot of the kid-focused. The smaller bicycles, the less expensive ones, have done particularly well.
I think we've also, and this is why you never have the same crisis twice, because we've also seen the playbook now from March through to June. We're in lockdown. We come out, what happens with people's spending? Like, you've got a business like Adairs that's got 30% of its stores are down in Melbourne and shut down, and the share price was up 8% yesterday, up, not down, right? And it's now trading at highs relative to where it has been over the past 12 months. And why is that happening? Well, people bought stuff online last time around. They're focusing on home. Investors hadn't really drawn that connection back in March and April that Nick Scully was going to go nuts, Harvey Norman's going nuts, and all this money's getting spent at home. But we now know how it works. So the second lockdown is not as scary as the first lockdown was. And I think that's applicable across a whole range of businesses. And I think through the large listed players have probably the profitability has held up better than anyone could have expected. We're seeing mostly surprises on the upside here. And I think you're going to see that through reporting season as well. Lots of hospitality type businesses, right? Mum and dad operators mostly are suffering really badly. But the bigger end of town with a lot of job seeker support is doing quite well.
Steve, you know I could talk about this stuff all day. There's so much that we could delve into in the bigger picture, but let's get back to the questions because they're still coming in. This is for you specifically, Steve. Have you been selling or buying units in the Australian funds? There's been no change of directors' interest notice announced recently.
Yeah, so our Australian fund's listed on the stock exchange, and this question, I said in our Q&A on Wednesday that I've been buying some units recently, and there hasn't been any announcement on the stock exchange. The question was why, and the reason is we're not actually directors of that entity. So if you see a lot of listed investment companies, the CIO of that company will be on the board of it, and therefore will disclose all of their purchases and sales. This is a trust that has a responsible entity, and we're the manager of the trust. So we don't actually have those same reporting obligations. I would hope it doesn't come as any surprise to anyone that I've been buying units in both of our funds over the past 4 or 5 months. I'll speak for Gareth's been buying a few as well. We're in the old school of trying to buy low and sell high, and things are particularly low at the moment. So, personally, I think it's a great opportunity to buy a fund that has been going through difficult times, but we think has the same prospects that it's always had, and you're buying it at a 20% discount today versus a 20% premium a couple of years ago. And
backing yourself. All right, what is your current view on CLX, Perth-based CTI Logistics?
Yeah, so CTI is an interesting business. The core of it there is it's a logistics, transportation, warehousing business. WA hasn't, the WA economy hasn't had the rebound that we were hoping it would have had. This is all pre-COVID. We've held the stock now for a couple of years. There is quite a lot of buildings and land tied up in this business. There's a decent NTA there to back our valuation on. But we really want to see a turnaround here in some of the WA-focused, some of the WA businesses to really accelerate that. And it is a bit of a small business. It is majority owned by directors and management, and that is helpful in that we think they have the best interests of shareholders like themselves at heart, but at the same time it makes the stock a little bit smaller and a bit less liquid, more difficult to involve other investors in that business.
I talked earlier in the week about the size of our fund and the types of opportunities that means that we can invest in, and really across both funds, I'm pushing the team really hard to save those illiquid things for businesses that we think either have some sort of cash return catalyst or they can really grow over a long period of time, because the cost for us getting into these illiquid stocks and then the cost of getting out on the other side, we could not sell this CTI Logistics if we wanted to. The liquidity has really dried up. We've got a big position in the company. It's not growing. It's not making great amounts of profits. There's some things to like there. There's inside ownership. I think they will do a job over time of allocating the capital okay, but I think the lesson for us has been to reserve this illiquid part of the portfolio for businesses that we really think can compound our value over time, because if you're just going to buy it cheap and sell it at fair value and it's going to cost you 10% in and it's going to cost you 10% when you get out, it's a really hard way of making money at a larger size. You can do it if you're investing $1,000. It's harder when you're putting $3 and $4 million to work in some of these things.
Companies that can sustain really high dividends is another one.
Yeah.
Potentially look at.
Yeah. So we want our return to come less from the entry and exit of the investment and more from the company itself. And that is either it's going to give us cash back in the form of dividends or some other form of capital return, or it's going to keep our money but grow over time. And either of those things are fine. What we don't want is I'm hoping for the market to re-rate this thing so I can get out because it's just expensive on the liquidity side of things.
Okay. I wish I had names for some of these questions, but this is obviously coming in saying, guys, it's a terrific presentation from Wednesday that you've put up on YouTube regarding the international fund. So I'll look at you, Gareth. That's a phenomenal result, especially with the 3 smaller cap stocks, Blanco, GAN, and Celsius. How do you source ideas like this and keep doing so? I don't know if that was a "and keep doing so" or with a question mark at the end.
I wrote a blog post on my personal idea sourcing process a few years ago. I'm happy to point that out. I can't remember what it was titled. I look at a lot of other investors for ideas. I do a lot of screening. I read widely. And I often do what's called an A to Z. So I go into a market and I really try and look at a couple of hundred names in a day and just see if anything pops out. Harvey's got a very different process. He's a little bit more directed by what's coming in from brokers, and he's got a big network of people that he's worked with and kept contact with over the years. Anything to add there, Steve?
Look, I think I've interviewed a lot of people over the years, and every single person that comes for a job says, I'm really passionate about this and I'm enthusiastic about it and I want to do it with my life. I would say the percentage of people that genuinely live and breathe it is really, really small. And I think in terms of idea generation, you just need to turn a lot of rocks in the right place and you need to throw a lot of them away. And if you turn enough, there's going to be something come along one day that you go, this is really exciting, but you need to enjoy that. It needs to be part of your life. And I think with Harvey joining the team, it's almost exhausting, the amount of things that come in.
Next level.
We've
He's definitely next level.
Harvey was here on Wednesday.
Yeah.
He's in the US right now, co-portfolio manager for the International Fund.
Well, we were talking this morning. We've got a very good friend of ours, Alvise, who worked with us for years, and he's gone off and worked for another fund, and it's going really well. But Harvey talks to Alvise more than we talk to him, and we're really good friends of his. He just wants to swap ideas with people and talk about things and understand what's happening out there in the world. And I just think that curiosity and interest in what's going on, it almost doesn't matter where or how you're going about it as long as you're doing lots of it. And if you're doing that and you're thinking about how an opportunity might arise, then you're going to find things over time.
I think that's the key. We did a presentation a couple of years ago on a roadshow talking about why a stock might be cheap. And that's really the first filter for us. Why could this situation be mispriced by the market? And everything else is more, how do I apply that? Where am I going to find things that might be cheap for a reason?
Yeah. And I think that discipline around the setup here is just not right. It looks like a great business. It's growing like crazy. I get on Twitter and everyone's talking about it. It's unlikely that you're going to be getting a bargain there. So it's just having the discipline. We're tiny. We only need a small portfolio. We can afford to miss a lot of winners as long as the ones that we do focus on work out for us as well.
Good. All right. What does the Aussie team think of beaten down stocks in the building industry? And an example that's being put forth is Fletcher Building and the REITs, such as Vicinity. It's a good question. It's been so topical lately, obviously. Is value starting to emerge on a 3 to 5 year view in these areas?
Well, maybe we start with REITs because we've talked about it in both funds. There's lots of US listed and European listed assets in that space as well. And not surprisingly, we've had a pretty good pick over it in terms of setup. There's a lot of pessimism and a lot of worry. And
we've been looking a lot in the UK as well. The prices are attractive enough, I would say, but we've also had this incredible 6 months where we've been able to pick up great operating businesses at too cheap prices. So again, it's that opportunity set and working out what's the best place to put our money. We're looking in the UK at least.
I think the issue in the space, I tweeted about something in infrastructure yesterday as well, is just the leverage. I think if you look at the equity yields on these things, and even if the rent falls a bit, you're still going to be earning very high yields on the likes of a Westfield. I think the lenders to these businesses are going to be much more nervous than they were 2 years ago about the amount of leverage that these companies can carry. And if you take a Unibail or a Redemco, for example, its debt costs at 1.5%. So if you have to take equity, let's say we go and issue a whole heap of shares and we go and pay that debt off, all you're saving is 1.5% a year of interest. So your income doesn't go up very much, but now you're spreading it across twice as many shares.
The background there is if it's got too much debt, even if it's cheap debt, it won't save you because you're going to replace it with something that's more expensive.
So I think there's this massive deleveraging process that probably needs to happen across the space, and it's going to make some of these attractive looking equity prices today look less attractive.
I think something in for example, the shopping centre space, it's really a three-part process here. You need to work out what the hit is going to be to rental streams. You need to then work out what the hit is going to be on the class overall and the capitalization rates that are applied to that income to come up with the asset value. And then the third part of that is, well, if that capitalization rate means that your assets are now worth less, the debt holders become, as Steve says, more nervous, and you could end up having to raise equity. So all three of those things feel like they're moving in the wrong direction. Yeah. So you might be looking at a yield on the equity that seems attractive, but you then have to reduce it for the rent and then the equity that needs to go in still.
Yep, so rest assured they've given this some thought. Fletcher Building, so building industry. Alex, do you look in that space for any value?
Not as much in that space most recently. I think we've been served up an opportunity in a lot of in some of those larger stocks, in case of a Star or a Sky City or what have you in the Australian fund. We've taken those opportunities where we can. The building stuff hasn't popped up on our radar too much at the moment.
I mean, I've had a pretty good look at Fletcher over the past few years. It's been a constant stream of downgrades and problems and write-offs, and I guess the experience of our performance over the past sort of 3 to 4 years has made me a lot more wary about just wading into these things and assuming that something's going to change. I think there are problems with the management and the governance of that business over the past few years. Every single announcement has been, we're turning things around, and it hasn't. And I just think there are simpler problems to solve out there than trying to solve a complicated one like that, which I guess is to Alex's point about some of the casinos and things that we just think are easier. And also just in terms of the balance of our portfolio, we've got lots of things with problems and we're seeing signs of turnarounds there, but we just want to make sure our portfolio's got a balance of things that are going through turnaround with some things that have been well run and we think are more likely to recover as well. And I think Fletcher, if we had a whole portfolio here that was humming along and doing really well, we might say, okay, we're prepared to take on a bit of that time and effort to get our heads around something like this that's more of a turnaround. We don't need it at the moment.
Good. Okay, so somebody has asked how they can buy New Zealand fashion retailer Halliston Glassons, so that's Glassons, right, that are in the malls here as well. Which fund owns that stock? Because they want to clarify if both funds can own New Zealand listed stocks and perhaps tell us a little bit about the business. Is it an easy one for Australian investors to access themselves?
We own it in the international fund only at the moment. There's nothing stopping us owning that in the Australian fund
Would
now.
Would you ever double up between funds though?
Yeah.
We would, and we have.
We've got one right now.
Correct. Tourism Holdings is one that's in both funds at the moment. We bought this in the international fund before we could buy Kiwi stocks in the Australian fund. Chloe, who unfortunately couldn't join us today, but it's a favourite of hers, both as a shop, the Glassons shop here in Australia, and as a business as well. It's a good dividend-paying business that we think can grow over time and pay us nice, healthy dividends. And they've managed this transition to online really, really well. I think the business is going to report better results. It's another one of these businesses where the stock price hasn't really recovered, but I think it's fairly obvious that the business is going well and will report some good results. So we're pretty optimistic about it. It is very, very illiquid. And again, when I ran through where we're trying to move our Australian fund from and to over the coming years, getting more liquidity into the portfolio is really important to us. And at the moment, adding another highly illiquid stock to a portfolio that's already illiquid is a hurdle that we don't want to jump over, but we wouldn't rule it out because I think it's a really nice business that would give us some retail and exposure in a fund that doesn't have a lot of it.
So by that answer, it's illiquid. It's more difficult for Australian investors to get in on their own.
I mean, if you're retail, you can buy it on the Kiwi Stock Exchange. I mean, it trades enough for a retail investor to own it. But in terms of products of ours that you get exposure to it, it's in the international fund. It's probably a 3% weighting, maybe a bit less with everything else going up so much. Yeah.
Here's another one. Are the realized losses from investments like MRM, Freedom, FIG, available for use to offset future gains elsewhere in the trust vehicle?
Yes, they are. So the trust will carry forward any accumulated losses. We would have chewed up something that has been realised, like MRM was probably chewed up last year. But there's a few things in here that we still haven't been able to realise the losses on, despite it being worthless. And at the moment, freedom is still one of those. But we will realise those losses over time and offset future gains. I mean, Gareth said this to me the other day. It's another thing I think about the fund at the moment, that its performance has been bad. So you're not paying performance fees here for a long time because we need to earn back the underperformance before you start paying performance fees. You're buying it at a discount. You're buying it at a point where any gains that we make, we're going to have losses to offset them for a period of time as well, so that the tax setup is quite good. I think they're all we need to make money. That's why you invest with us. But at the side, I think they're all additional reasons why you might want to think about an investment.
Okay. If you have more questions, we are past 12:30, but we're happy to keep going. We've got some here. We've got U.S. banks. So Gareth, Wells Fargo and U.S. Bancorp seem particularly unloved at the moment, still at March lows. Is this an area you have looked at?
Not closely. We own a little bit of Lloyd's in the international portfolio. Steve and Chloe do more of the work on that than me. They're cheap. They look cheap, superficially cheap. There is this transition going on from Wells of 15 years ago. You would say this network of branches that they're out there in the community is a very, very important part of it. And there's just so many ways now for potential competitors and existing competitors to attack that space without having a network. And I think some of their advantages get taken away as a result of that. And then there's a whole bunch of specific problems as well with individual banks.
Yeah, Wells specific, Gareth's talking about there. I think the whole space, if you're sitting there saying value as a genre is really, really beaten up, and I think all of this growth stuff's just gone way too far and it feels like a bubble to me, I would say the number one way for you to get exposure to a change in that is to buy some of the world's best banks. They trade at extraordinarily low multiples of book value. I think in the two big US banks, Citi and JP Morgan, you've got two businesses there that are globally dominant in the investment banking space. I think they're really good franchises. We own Lloyd's in the UK. This business trades at about 40% of its book value. We think it goes back to earning an appropriate return on that book value over time. So you're buying a company that I think can earn 13 to 15% return on its book value at 40% of its book value, and it's probably over time going to pay most of that to you as distributions. Everyone hates them. The interest rate environment is low. The net interest margin that they make keeps going down because they can't charge their customers enough, and the rate on deposits goes down.
And the provisions through the pandemic.
Yeah.
There's all these reasons people hate them. There's all these reasons people hate them. That is the UK's biggest, best run bank. It's really well capitalised. I think the risk of it getting into serious trouble here is very small. And if you can ride out the next 2 or 3 years to a recovery, you're going to do very well in that space. So, I mean, there's lots of crazily attractive stuff in the value space out there as well. So it doesn't need to be banks, but I think they are a barometer of the sentiment towards the space.
And there's a little bit of that in the Australian fund as well. We own a small position in Virgin Money as well, which is a UK bank. Now it probably hasn't had the same, won't have the same category leading dynamics that Steve was talking about with Lloyd's, but it is also priced at a much reduced multiple of book and has the ability to get back to earning decent returns on that tangible equity as well.
Okay, I need to go back to one thing that you mentioned. If you're wondering if tech is in a bubble, is tech in a bubble? Gareth, sound like you've got a view?
No, I was just laughing. There's definitely some. It's quite a unique time. It feels like quite a unique time, and there's definitely some parallels with 1999 at the moment in terms of just things. One sector being a massive focus of the market, all the day traders returning to the scene. They've been absent for 20 years, but at the same time, we've made some good investments in stocks that were cheap 6 months ago at least, and made a lot of money out of them. So it's a bit hard to poo-poo the whole move.
And I think there is a balance here. Like there is a huge amount of change happening in the world, and with change comes opportunity and great investments that can grow for really long periods of time, because the old competitive dynamic that was stopping this creativity is over, and you're getting these businesses that are growing at faster rates and for longer periods of time. And I think a lot of us made mistakes underestimating how much those businesses could grow. I think what I'm seeing a lot of now, though, is just buying a story, irrespective of the price. And I think as soon as you start not caring about what the price of the business is, that is an environment for bubbles to take hold. Because I make this argument about the gold price all the time. Someone comes to me and says, "Oh, there's all these great arguments for buying gold." So, okay, you can make that at $2,000. You can make exactly the same argument at $10,000. You can make the same argument again at $20,000. And I think there's a lot of that going on in the stocks world at the moment. It's you buy this business because X, Y, and Z is going to happen, and there is no reference to what the appropriate price is for that. So we're still looking at, I think, trying to find businesses that can grow over time is the recipe to investment success. And I think they're still out there in terms of things that people are not interested in at the moment. But wow, there's some extraordinary prices being. I'll give a really good example. So Ocado is a business that Gareth and I had a good look at a few years ago. It's gone up tenfold since we decided not to invest in it. I saw a broker note yesterday, and the shares currently trade at £20, right? Yeah, 2000p. And the broker note said, well, if this company can if online penetration of groceries gets to 50% and Ocado ends up with 25% market share, it's going to be worth £21 at that point in time. And I just look at those assumptions and I go, they are heroic. Yeah. They're not impossible, but they're heroic in terms of how much success you need that business to generate to justify today's price. And I just look at that and I go, that is a crazy risk-reward trade-off for me.
That's true, but I would call Ocado, it's a real business, and it's a real. Absolutely. And what I'm looking for here is the pretend businesses, I guess. Like at some point in the bubble, the investment banks start effectively manufacturing companies to fulfill a demand for the investors, and that's what we're looking for, the ghost companies or whatever you want to call them. I'm seeing more of it than I have in a long time. It's not quite at 1999 levels.
Okay, that sounded like a place that we could naturally wrap it up, but I'm going to keep going because we're getting more questions in, saying a lot of success has come through this year in UK, European, and US markets. You seem to have retreated from Asia. What are your thoughts on the opportunities ahead and long-term? Can you ignore growth in Asia? I think we sort of addressed that one a little bit earlier. It was not now, not for the foreseeable future.
One point we'd make there is that GDP growth and stock market growth are very different things, and they're not strongly correlated. The great growth companies don't have to come out of the great growing markets. And the other thing I would add here is Asia's a place where local knowledge, I think, is particularly important, and I just don't think we've proven ourselves there at any point in the past.
Yeah. I mean, is it even fair to say so much of the growth or performance has come from Europe and America? I guess Gan and Blanco, yes, both listed. I think one of the most prospective areas for us has been businesses that are listed in a market that is not where most of their revenue is coming from. So most of the investors there are not familiar with the product. They're not necessarily industry experts that are looking at it in the space. And a lot of our success has come from, okay, if this was in America, people would be valuing this at 3 and 4 times higher because they know what's going on in that company's end markets. Look, the divergence between the US and Europe and the UK in terms of market performance has been absolutely extraordinary over the last 5 years. And us having more exposure to the US over the past 12 months has been a huge reason why we have outperformed by as much as we have. That says to me that the opportunities are on the other side of that equation, but also all of these growing tech companies that are eating the GDP of the world are listed in the US as well. So I think there are fundamental reasons for it. Again, sometimes the momentum of that narrative gets carried so far that the opportunities are extraordinary on the other side.
Okay, well, I hate to ruin this momentum because it's been good, it's been fun. Thank you, Gareth, Alex, and Steve. Obviously, more questions coming in, but I think that's a wrap for now. I'm sure you're happy to engage with investors.
Absolutely. We'll try and get back to everyone on email if your question hasn't been answered today, and I'll send you something through.
Good. That is the Forager Funds Investor Roadshow for 2020. Thanks for joining us for the live Q&A.